Welcome to Sense and Sensibility, the Inflation Guy podcast. I am Michael Ashton. I am the Inflation Guy, and I am your host. And today on the podcast, we're going to talk about de-dollarization, which is a scary term that has been widely discussed recently, mostly with lots of screaming and gnashing of teeth. What does the term mean, de-dollarization, and how would it happen? And can it even happen? To discuss this, I have a very good friend and a deep subject matter expert joining us today, Andy Faitley. But before we get into that, a word from our sponsor. This episode of Sense and Sensibility is sponsored by Simplify ETFs. Simplify is a new ETF provider offering alternative investment strategies with full transparency, daily liquidity, and low costs. Some of their hedge fund style strategies include managed futures, commodity trend following, steepener trades, and more. If you are an individual investor or RIA, you will likely find a compelling alternative investment from Simplify that can help improve your portfolio. Check out their website at simplify.us. That's simplify.us, and you can find their entire lineup of ETFs at simplify.us/ETFs. Thanks as always to Simplify, and I appreciate your patience. Obviously, the sponsors would allow us to bring this to you, and so thank you very much to Simplify. Okay, one more preliminary, and that's the trivia question. My guest can help me with this one, and we'll answer it at the end of the pod. And here is the question. It kind of harkens back to my last guest, who talked with us about insurance. So here's the question. You know the insurance company Allstate? You're in good hands with Allstate. It's one of the most famous slogans of all of advertising. And the question is this: Allstate was founded in 1931 as part of what iconic American company? Don't answer that yet. Don't answer that yet. We're going to answer that at the end of the podcast. Or you can answer that. If you're listening, you can answer that. Okay, so now for the main event, we're going to talk with our guest about de-dollarization. Foreign exchange movements are very important to inflation guys, as you might imagine, even more so in other countries because international trade in the U.S. makes up a smaller portion of GDP than for the United States than it does for, say, Germany. So it's an important topic. It's not something I've ever been particularly strong in. And so to help us make sense of it, I have my go-to guy on foreign exchange issues, and that's Andy Faitley. Andy is a 40-year veteran trader and analyst of the FX markets, good friend of mine, and really is my go-to guy. If I can't remember which way I'm going, if I say I'm buying the euro, Andy is the one that I call to make sure that I'm doing the right direction. And we've also even co-written a paper before on central bank digital currencies. He's very deep in the crypto space as well. And then, like I said, he's my go-to guy on FX. He's also known in the markets as the FX poet. For many years, he's written a daily note that begins with a limerick or other poetry based on things actually happening in the markets, which is amazing to me because every day to produce a written piece of prose is hard. Written poetry, I can't even imagine. So he's an interesting guy. So, Andy, welcome to the program.
Thanks for having me on, Mike. I appreciate being here.
Well, all right. So can you help me first by fleshing out your background, the brief background I gave, and by letting our listeners know how we met, worked together, and giving just sort of the background as you see it.
Sure, be happy to. Under the rubric of be careful what you wish for, you just may get it. I got involved in the foreign exchange market after a summer job between my junior and senior years in college on a trading desk, and decided instantly, as soon as I opened the door to a trading floor, that I was going to work on a trading floor. Went back to college, took international finance classes, learned about the foreign exchange market, and I said, this is going to be perfect. I'm going to get into foreign exchange. And that was 4 years ago. And here I still am in foreign exchange. So you got to be careful. I had initially wanted to be a trader. It's all I really cared about. I was a trader for a long time, traded spot foreign exchange, which is sort of the price you see on the screen, forward foreign exchange, which is really, it's a financing tool. It is a very common product that's used for hedging by corporations, by institutions when they've got exposures in foreign assets or liabilities, and options. In fact, my master's thesis was a pricing model for foreign currency options, which I really hurried to finish before they actually started trading on the Philadelphia Stock Exchange in early 1983. And of course, because I was simply an MBA student, I was not published. However, the Garman-Colehagen model, which is the basis for pretty much all foreign exchange trading options trading, it was exactly what I put together. So I got it right. I just am not important enough to have been, like I said, MBA students don't get published. Finance professors get published. But that was all fine. Got to work, went to work at a number of banks. I've worked for foreign banks. I worked for U.S. commercial banks, U.S. investment banks, Swiss, Canadian, British, Japanese banks across the spectrum. What's the interesting? The interesting thing is, while they all do the same thing when it comes to foreign exchange, they all do them really differently. So, anyway, we met at Barclays. So I joined Barclays in the beginning of '98. I'm not sure when you joined. I'm going to say it was not far from then. I think you were
beginning in 2001, I think.
Okay, so it was downtown. I remember, because we hadn't moved to Midtown through 9/11 yet. So I was hired as a trader at Barclays. I was trading FX options there. I actually started up our emerging market currency options business and was trading that during that period. And then subsequent to the Russia default, so October of '98, when Russia defaulted, the little known thing, people talk about how dollar yen has moved. Dollar yen had 2 consecutive, I think they were 12 standard deviation movement days in a row. Which I guess theoretically should not have happened in the universe at this stage on a statistical basis. And yet there you were. Implied volatilities exploded higher, and we did not get a single client inquiry on the desk. And I asked the gentleman who ran the room, I said, does anybody talk to our clients about options? I just had the most extraordinary move, arguably in the history of the options market, and nobody asked the question. And they said, no, we really don't do that. And I said, well, geez, I would do that. And that's how I started the process of moving over to coverage, and wound up, as it happens, covering corporate America for the ensuing many years. Which turned out to be a good thing for me, because what I found out was that most of corporate America didn't really understand how to manage the risks. If they figured them out, they didn't really get the whole risk management aspect. And my role became as an educator. And I educated my clients how to manage risk, what to do, what the different tools they could use, and when they were good to use and when they didn't work, and how market pricing could impact them. And that's how I've made my career.
You know, that's really interesting, that last piece, because it's very parallel to sort of, me and inflation, and that, educating and helping risk management for people who don't necessarily understand what their exposures are, how they can hedge them, how that there are instruments out there that can help them. It's just that you've been more successful in teaching that than I've been successful at teaching inflation. But it's very interesting that we did have that parallelism in our careers, and I'm very glad that I've met you and that I've known you for the last quarter century, because now I can ask you the question that's on everybody's mind, which is, what's de-dollarization, and why is it? What is the threat? What the effect of it would be, or whatever. And I guess we should start by defining what the heck is de-dollarization. How would you define it? And what is the nightmare scenario that people typically throw out in the usual bear porn stuff?
It's very interesting to me, because this story has recirculated over my 40 odd years in the market. Every time there's any protracted dollar down cycle, this is one of the things that happens. And as you go back to your international finance books, and they talk to you about how a currency's value adjusts based on the current account balances and flows driving that. And when a country is in deficit, its currency will weaken until those flows can balance, whether they're trade balances or current account balances, investment flows. And the truth is that for a lot of countries, that's very true. If you look at Brazil or Turkey or Mexico or Korea, or almost every emerging market, inflation numbers and current account numbers matter a lot to the market. They tend to be, especially the more open the economy, the more they matter, because what will happen is that those flows will drive changes in behavior, both domestically and internationally, and the currency is the release valve. So it's not that surprising. And you can point to it. You can look at, on a day-to-day basis, the number of times you would see a surprisingly large negative balance of payments or trade number from some country, some emerging market country, and the currency would fall 2%, like immediately.
Okay, so just to be concrete here. So Mexico reports a big trade deficit, which might happen if I guess oil prices plunge or something.
Right, exactly right. Oil prices fall, their exports sink, and then the peso will weaken accordingly. And right away. Like it's not like it takes 2 years for the peso to respond. It's like it takes 2 minutes for the peso to respond to that.
And why is that?
Again, that is the market literally. That's international financial textbooks working in front of your eyes. That is how the market adjusts the price of the currency, because for Mexico to be more competitive, if it's going to have a trade deficit, Mexico can't afford to run a trade deficit because nobody buys bonos. They can't finance themselves in that manner, and therefore a weaker currency is the only way that they can put themselves in a position so that their exports become more competitive, they sell more stuff, their trade balance goes back towards parity or positive, and therefore they can pay their bills internationally. So it's not the finance books are right for a lot of the world.
So it doesn't work quite that way for us, and that's because we have some sort of outlet valve, I guess, right? So,
well, that is it doesn't work that way. In fairness, it doesn't work that way for any of the major currencies. So it clearly does not work that way for the dollar. Doesn't really work that way for the euro, the yen. After that, well, the renminbi is pretty restricted. Or the yuan, whatever you want to call it, China's currency is a restricted currency. So its movement is orchestrated by the People's Bank of China, their central bank, much more than it is by markets moving it based on flows. Mm-hmm. But that's really the difference, is that when a currency becomes weighty enough so that it has many more things other than simply its trade balance as the driver as to why people choose to own it or not, then the trade balance just diminishes in relative importance, and therefore the impact on the currency for a surprise in either direction is significantly reduced.
So
that's the way to look at it.
Yeah. So for example, if you're a safe haven currency, for example,
right,
that something crazy happens in the world, and it doesn't matter what the trade deficit number that came out today was, everyone wants to flee to the yen.
Correct. So through my career, I will tell you that, like right now, although I guess CPI is sort of usurping the mantle of NFP. So the payrolls data was the big data point for a long time in the FX market. People held their breath into the payroll number, and if the number was high or low or whatever, let's talk about pre-COVID, that was the number that mattered. But if I go back early in my career, when Paul Volcker was Fed chair, M2 was the number that mattered. because that's what they paid attention to. And so it was released, if I'm not mistaken, at Thursdays. It was at 4 p.m. and then they moved it to 4:10 because they wanted to release it after the stock market closed.
It's fully closed, yes.
And right, and all the options had closed and everything like that. And so just like on trading floors all over the world, when the big numbers coming out, there are desk pools as to what that number will be, and everybody puts in $10 or 20, whatever the number is, and whoever's closest wins the pot. That pool was on M2 when I first started. Subsequently, during the Reagan presidency, well, that was during the Reagan presidency, but subsequently in the wake of the Plaza Accord, when the U.S. You may or may not remember voluntary import restrictions by the Japanese, or voluntary export restrictions by the Japanese autos, because they were selling too many Japanese cars in the US. The big three were getting killed. And that's when Honda was the first to open, and I think in Marysville, Ohio. But then Nissan and Toyota obviously opened factories all throughout the South to build cars here so that they were no longer exporting. We were importing them directly. But at that point in time, the trade balance was the number. Friday morning at 8:30, well, at 8:30, the day came out. It seemed to come out on Friday morning a lot. It wasn't, I don't think it was technically that way. It just seemed to work out that way. So again, 8:30, the trade data came out. And if there was a significant deficit, then the dollar would fall. If it was if it was less of it, it's always been a deficit. In my career, I've never seen a surplus. So the question was the magnitude of the deficit versus what the expectations were. And then at some point, I would say post the GFC is when we moved to NFP, the non-farm payrolls number, which is, of course, the first Friday of every month. I guess there's some exception where it can be the second if the first is the Friday or something like that. Yeah. It moved to that, and that became the data point that mattered, and everybody was focused on that, and that was the driver. And so it did drive markets, but I think it had a bigger impact on bond markets. It had a bigger impact on the equity futures markets. It had to be really remarkable to move the dollar a lot. The dollar and trade, I think you mentioned earlier, I think the numbers I looked up, trade as a percentage of the US economy is like 12%. Just as an example, I just remember this off the top of my head. Trade as a percentage of the Dutch economy is 137%.
Right, exactly.
Okay. Yeah. So the trade balance isn't that important to the dollar's value because it's just not that big a portion of what we do.
Yeah, it's a lot of dollars, but we have a lot of dollars.
Correct. So, correct. So anyway, so I feel like that's how, there's this implicit belief that this is what matters. And of course, we've been running trade deficits, I think, since 1975. And we've been running budget deficits since, so during the Clinton years, I guess we got 1998 through like 2000, 2001, we had very modest trade surpluses after the contract with America, et cetera, forced the change there. And then we went right back to deficits, and those deficits, of course, are growing arguably exponentially at this point in time. So we run a huge government budget deficit. We run a huge trade deficit. It's got to get funded somewhere. We have large capital account surpluses, right? That's the end.
So let's go through the mechanics there, and then again, I want to get to sort of the disaster case here or whatever. But so those two sort of have to be tied together, right? We sort of have to tie our trade deficit and our budget deficit sort of have to be tied together because well, I mean, you can describe sort of which direction the causality runs, but it's, at some extent, if you have a large budget deficit, it's got to be funded either by domestic savers or foreign savers.
Right.
And the question I've always had is, well, does that mean, fortunately for us, those foreign savers happen to have a lot of dollars that they can go buy our stuff with. Which one leads which one?
Well, I think that's actually the kind of the crux of the situation, right? The issue is that I don't remember who said it. I did not come up with the idea, but basically, other countries around the world make stuff, and we make dollars, and we give those dollars to other countries, and they give us their stuff and they take our dollars. And that's it's by far our largest export is dollars.
Seems like a good deal because it costs
right.
very, very little to make a dollar.
You know, it is. I've seen this because the Austrian camp hard money guys are, we're going to destroy the economy, and the contra is, what are you talking about? This is the best deal ever. We give them paper and they give us stuff that we need. Like right. what could be bad about that? And of course that's the way it has worked for a long time. And the question becomes, as in all of sort of everything, it just, as it builds on itself, it just becomes I think the concern now is this reaching a point where it is no longer sustainable?
Yeah, right? Can a tree grow to the sky?
Exactly. It's not Ben Stein, Herbert Stein, right? Something that I always think of him as Ben's father, but exactly. So Herbert Stein's famous comment that if something can't continue forever, it won't. And so, right. And I think that is the genesis of why we're getting so much of this de-dollarization discussion. And I had written a piece back at the beginning of the month, and I copied 1, 2, 3, 4, 5, I think it's 8 or 9 headlines here that were just sort of typical of what this conversation or how this conversation has been going. So I will read them, and I will put them in the show notes. I'll give them to you so you can. Yep. I honestly don't know which sources they're from, but they're all legit headlines from major media sources. Russia embracing the Chinese yuan for much of its global trade. Saudi Arabia considering invoicing oil exports to China in yuan. France buying gas from China in yuan. Brazil and China agreeing to ditch the dollar for bilateral trade. BRICS countries, and for everybody who doesn't know, the BRICS countries are Brazil, Russia, India, China, and South Africa, plan to develop a new reserve currency. Kenya promising to ditch the dollar for oil purchases. ASEAN members discussing dropping the dollar for cross-border payments. So ASEAN is the Association of Southeast Asian Nations. It's a club, I don't know, whatever. It's kind of like an OCC, what do we call it? OCDC club, but for emerging markets in Asia. India settling some trades in rupees. So those are the sorts of things that drive.
Andy, this sounds disastrous. This sounds horrible. What's going to happen to the dollar if no one needs the dollar? Andy, what's going to happen? What's the fear?
It's funny, and we have talked about it a little in the past, and one of the things that I think is very true is that it's very easy to look at these headlines and get nervous about, oh my God, the world is ending, the dollar is going to collapse, no one's going to want the dollar. And then if you ask the question,
if they don't take our dollars, that means they don't send us stuff.
Right. Exactly. I mean, that's the essence of the problem, right?
Right.
We've gotten very used to trading dollars for stuff. But if you ask the question, okay, what will they do with all the dollars that they currently have? And I actually dug up some data for this. Because
you're prepared. Andy, I can't have you if you're gonna be prepared. makes me look bad.
No, it's just the numbers are staggeringly large, and the big part of it is because it's all in the trillions, and so we don't right. So it's hard for us to get our head around what a trillion is. So global GDP, okay, the product of everything in the world in every country. The World Bank's estimate for last year was $104 trillion. Okay. US GDP was 25 trillion of that. So we were kind of running at a quarter. I think Chinese GDP is 18 trillion. And then like number 3, who is probably still Japan, is like 3 trillion.
Right.
Right. I think that's the way the number. So it really falls off once you get past 2. And total debt. Okay, so but this is really the issue. So total worldwide debt is $305 trillion. Oof. So the world is 3x leveraged. Okay, so I don't know. So 3x leverage, I guess, would be kind of a triple B credit. As the world at large is triple B credit. Okay.
Sure. That makes sense to me. That makes sense to me. But on the other hand, leverage is great. I mean, we love nice levered, tech companies, right? So
Exactly.
As long as we have gains, leverage is good.
So global equity market cap, $109 trillion. Okay, so the Buffett indicator, right, which is market cap divided by is market cap divided by GDP, right? That's the Buffett indicator, is basically 102. Okay, 102% on a global basis. But the real crux of it is that the debt numbers are the real key. $235 trillion of debt outside the US. So you've all heard about, we've got 31, right? The debt ceiling is the big topic right now. $31.4 trillion is the debt ceiling. And then if you add up the rest of the debt in the US that's been issued by corporates, by banks, by blah, 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 all of that stuff, the total comes to about $80 trillion. Okay. That means the world has a lot of dollars debt. And that's really the key. Okay. Why is that? So let's go back to a second, because
you mean that the world outside the US owns a lot of,
not owns it, issues it too. Like
yes, right.
They issue it and they own it. Okay.
They
issue it and they own it. And here's the thing is that let's talk about the dollar as a reserve currency. Okay. And I think one of the things that happens a lot is a conflation between the reserve currency and a reserve asset. Okay. A reserve currency is the currency that nations own because, I mean, for three reasons. They have trade, international trade, so they need to hold it to pay for their bills. A common way you hear about it is they have 3 months of FX reserves or a year of FX reserves or whatever it may be. The Asia financial crisis in 1997 was caused by a lack of reserves. And so what happened subsequently, when all of that ultimately shook out, all the Asian countries that were part of that, Indonesia, Malaysia, India, Korea, Taiwan, pick your country, China, they stockpiled reserves like there is no tomorrow. So they all have massive currency reserves. And
we really don't hear about that actually until they start to get low. You hear right. You hear them in the emerging economies in South America, whatever. Like,
remember this, that so a quick statistic right now, the IMF COFR data, they call it, showed that the dollar represented just over 59% of the total reserves, FX reserves around the world. Okay. Now that number has fallen from like 62%. So that 3% is a lot. But the next largest is the euro at like 23%.
So countries have to own dollars if they're going to do business in dollars, right?
That's exactly correct.
Okay.
And that's the other issue is that so if you listen to if you think about the headlines that I read before, they were all China is going to trade in yuan, Russia is going to trade in yuan, Saudi Arabia is going to trade in yuan, France is going to trade in yuan. All of these people are going to start to use the yuan instead of the dollar, right? So there will be less demand for dollars. And if they do that, there will certainly be somewhat less demand for dollars. So other little key numbers to remember in the foreign exchange market, which remember is the largest market in the world, the BIS, I think it was $6.5 trillion a day on average of volume in foreign exchange across the different products. 85 or 88% of all the transactions have the dollar as one side of the trade. So a lot of dollars trade every day. That's why the FX market is what it is. So for countries need dollars to trade with them, but countries need dollars because they borrow in dollars. So why do countries borrow in dollars? Well, because it's the only currency where they can. It's where the liquidity pools are. It's where the asset pools are.
It's because everybody has dollars.
Exactly. So I actually just looked up before to solve the number. countries have issued $23.5 trillion in debt, or had $23.5 trillion in debt, recently issued dollar debt outstanding. They have to service that debt. So a strong dollar is a problem for them, because if you're Indonesia and you have, $10 billion of dollar debt outstanding, and you're paying, let's say 5%, so you've got to pay $50 million a year in interest. Well, you need to have $50 million. So $50 million in rupiah, now rupiah is 15,000, so it's a lot of rupiah. It's
We don't have to be that precise, Andy.
Right. So is 75
Right.
billion rupiah. And if the rupiah weakens more, then maybe it's 80 billion rupiah or 90 billion rupiah that you need to generate domestically so that you can service your debt. And so that's kind of one of the big issues. So a weaker dollar helps everybody around the world, because it doesn't cost people as much to get the stuff. Virtually every commodity is priced and traded in dollars. Obviously, these headlines are showing that there are countries that are trying to get away from that. Russia, for obvious reasons. China, because, again, not surprising, there's a lot of friction between the US and China right now. No shock that China doesn't want to, quote, help the US with respect to paying its bills, et cetera, et cetera. But the other thing is, and that goes back to the amount of dollar debt that's around the world, is that if you're an FX reserve manager, okay, so you work for SAMA, the Saudi Arabian Monetary Authority. Okay, mm-hmm. These are guys, they sell oil to everybody. It's 36 million people live in Saudi Arabia. The amount of oil they sell, they can't spend all that money, physically can't get it. So they have excess reserves. And of course, the whole petrodollar story is that they agreed to buy treasuries with them at the time. Great. If they stop buying treasuries, what are they going to buy? Mm-hmm. And that is one of the key issues that, in my estimation, will prevent all of these things from having a substantive impact on the dollar's status within the world in terms of the concept of a reserve currency. Now, is the treasury bond going to remain the reserve asset? They're $31 trillion outstanding. All right, so the Fed owns $6 trillion. So there's $25 trillion outstanding. There's not $25 trillion outstanding of anything else. What are reserve managers going to buy?
Crypto.
Right.
25 trillion of crypto.
So I was listening to someone and they made a very interesting point. They said what people are concerned about, and I think rightly so, is that assets that, right, what we see as the debt problem, we have too much debt here. All the holders, for them, it's an asset. Yeah. So they have credit risk, right? So how do you, what asset is available that doesn't have credit risk? And arguably the only one is gold, right? I mean, gold doesn't have credit risk. Gold is just gold. And which is why people, the gold bugs are all a Twitter, because they think that this is going to be their chance for gold to go to 10,000 or 20,000 or 50.
I mean, kind of all real assets though, right? I mean, it's, it's silver doesn't have credit risk. Platinum doesn't have
correct. Any real
doesn't
asset.
have credit risk.
Copper, it doesn't matter. Yeah. Oil doesn't. But there's a big difference between gold and silver and oil, because oil is consumable and gold is not. Right? So you can have oil and then you can run out of oil. But if you have gold, if you hold it, then it's always going to be there.
Diamonds, property. Problem with property is you can't, and actually that is what Japan did with a whole bunch of its surpluses, right? Back in the 80s, was they bought a lot of American property.
They did. They Rockefellers, and they paid the top. So and if you go back to the Weimar hyperinflation, and the first effort that they tried to end that process was they were going to do essentially a land bank and have a land-backed currency. Yep. I can't remember what the term was, but there's some term in German to say that. So yes, you're right. Property, real assets don't have credit risk, but real assets are not fungible. They're not liquid. And if you're a reserve manager, you can certainly put some there. And you've seen last year, more gold was bought by central banks than any other time in history. I don't know what the number was, 150 tons or 200, some number like that. So clearly they're looking at ways to diversify,
Yeah.
but it's
Well, so I mean, it seems like this de-dollarization is really it's sort of two different things depending who's talking. One is that, one is the global reserve currency, the global reserve, the benchmark, and there's sort of a fin de siècle, notion that if it's not in dollars, then we're no longer top dog, and it's sort of the end of the American century and all that mess, which is, I think an interesting psychological thing to worry about, but financially that doesn't have any impact, right? I mean, the real question, I guess is and the other thing you hear a lot is, China. What happens if China sells all of their U.S. bonds?
So I love that question, and I do.
Tell us, Andy.
I've heard it. So the assuming they could, okay, right. Assuming they could, because they have, I don't know, let's call it, they have 900 billion in bonds, so it would have a pretty big impact on the market. But again, the question becomes, they sell their bonds, then they get dollars. So now what do they do with their dollars? They've got to buy something with them, because there's no
sell them, Andy. They're going to sell the dollars. Just sell them.
Okay, and that's fine. They'll sell their dollars. What will they get? What's the other side of the trade? Are they going to sell their dollars and buy Apple stock? Are they going to sell their dollars and buy gold? Are they going to sell their dollars and buy
euros, Andy?
Right. Okay. It is
hard to believe. Okay, maybe
it's not really viable. And the other problem is, if they sell their dollars for another currency or a range of other currencies, whatever, then the dollar is going to really fall dramatically. Like that would have a very large $900 billion one-way flow would have a very significant impact on the FX market.
And I think that's the real fear, right? So that's the disaster that people seem to be. Part of it is the dollar is going to collapse because China and everyone's going to ditch the dollar. So what's that do?
And that's, to me, that's the least likely outcome, because what would happen is the renminbi would strengthen dramatically. So the renminbi is roughly 7 to the dollar right now. So let's say it goes to 5. Okay, so that's a 25-30% adjustment. All of the stuff that we get from China would become a lot more expensive instantaneously, and we wouldn't buy it. Number one. Number two, China continues to run a mercantilist economy. Their entire economy is based on build stuff and sell it overseas and collect overseas reserves. So the consumption portion of the Chinese GDP it might have gotten to 50%. I thought it was still in the 40s. I don't know. It's around there, versus the US is at 70 something percent. So at 500, then Chinese people would find the rest of the world would seem very cheap to them. But boy, would that turn around the Chinese trade surplus, which is enormous. Would that turn around the Chinese manufacturing process, which would get crushed. The CHIPS Act, right, was recently passed because we need to support US chip manufacturers, semiconductor manufacturers, to prevent the Chinese from getting things, and want to bring more of it home. We don't want it in Taiwan, we want it here. All of that stuff, you would need a law to have that happen, because every company would go, yeah, okay, China's really way too expensive, so where can we do it? We can do it home for much cheaper. And I think it's just a non-starter. The Chinese would not shoot themselves in the foot for spite. They may do many things. They may hate the US. All of that may be true. But the one thing that I think we can be pretty confident in is that they're not going to hurt themselves to try to hurt the US.
Yeah, I mean, it seems like that would not be a winning move. And the effect on the US obviously would be very inflationary for us, but also would be highly expansionary for us, because like you said, we would suddenly get cheap compared to everybody else.
Right.
The economy would boom in ways that we've never seen. And which, by the way, and if we're exporting way more than we've ever exported, then suddenly our trade deficit goes away.
Right.
Right. And so, it doesn't strike me as necessarily a bad outcome other than the inflation. The inflation would kind of suck. But of course, but the Fed could drain dollars, and that was the case, right? In theory. So
in theory,
in theory, I mean,
no real history of that, but yes.
I mean, in theory, the Treasury could go, could intervene in the markets and buy all those dollars and
Right.
give them to the Fed to whatever. So
that's true.
It
dealing with
like,
inflation, in a scenario like that, where you would have, I would expect a significant rise in nominal GDP.
Mm-hmm.
Okay. And so obviously inflation would definitely pick up and the Fed would be able to address that. But I think that it would be relatively easier to tighten monetary policy in that scenario, given the other natural drivers of nominal GDP. And therefore we wouldn't have the employment issues, like that unemployment conundrum question of, would unemployment skyrocket because of, I don't think that it would happen. Right. And the US would become like, it would make itself, China would inadvertently arguably make the US the place where everybody wants to put their capital, because growth would be high, rates would be going up, and there would be returns, real returns.
So in other words, all the people who say that if there's de-dollarization, it would make us an emerging economy, we turn into just an emerging market again, are right. And that's awesome.
Right. In a way, I think it could be a big benefit for us. I think it could.
So I'm cheering for de-dollarization then, I think.
Well,
what's the downside here?
Remember, so this is the economics/finance of the question. There are other things that are involved. And I'm certainly not privy to it, but I'm aware that, let's talk about, at least this is from what I've read, my understanding, the freezing Russian assets in the wake of the Ukraine invasion. Mm-hmm. Okay. The Fed did not want to do that. They were categorically, no, this is a problem. The Treasury didn't want to do that. Janet Yellen did not want to do that. The CIA wanted to do that. And apparently that was where the call was. They made the case, and the Defense Department said, this is what we need to do. So there are obviously non-financial considerations that go into how things work. But here's another aspect of it. I think about the way China has evolved since Xi Jinping has become president there. Ruler for life there. And when Deng Xiaoping opened up the Chinese economy, and then when they joined the WTO in 2001, they embraced capitalism in a very significant way, and it did what capitalism does. It expanded the economy dramatically, and it lifted literally hundreds of millions of people out of poverty, and the people in China are much better off than they were prior to that. But the constraint, if you're an autocrat of capitalism, is you lose control. And losing control is something that Xi Jinping is very clearly not comfortable with doing. And my belief is that he's kind of, all right, we've gotten kind of far enough, and everything going forward is going to be, we're going to run the show again and put, and make sure that we get our long-term strategic goals. Like that's our goal, not, the people doing better. It is, I think you can tell the digital yuan, their central bank digital currency, which they're very clearly rolling out, this whole concept of social credit scores and things like that. I mean, that's all part and parcel of the same thing, as part of a control issue, which then takes me back to something I mentioned before. So if Saudi Arabia, all right, looking at invoices oil in exports in China in yuan, okay, great. Mm-hmm. Saudi Arabia runs about a $25 billion annual trade surplus with China. One of the few countries that runs a surplus with China. Obviously, they can't buy enough stuff to offset the oil they sell. So after a couple of years, they'll have $50 billion, and then they'll have $100 billion after 4 years. And the question is, again, what will they do with all that yuan? Because so let's assume the Chinese don't sell their dollars and the yuan stays at 7.
Yep.
So after 4 years, they've got 700 billion yuan. Are they going to buy their Chinese debt is very limited, like Chinese government debt is very limited. Are they going to buy Chinese local government debt, like levered munis? That doesn't feel like something they want to do with their reserves. Do they want to play in the Chinese equity market where you know, Xi Jinping has proven he can come out and say educational companies are doing the wrong thing and they need to, you know, like we have to stop that, it's not fair, and drive the values down. And if they're in the wrong sector, then the value of their assets collapse. So here's the thing, and China's been buying up gold like there's no tomorrow. Can the Saudi Arabian Monetary Authority go to the PBOC and go, hey, we have all these yuan, we'd like to convert them to gold, please? Will China say no problem? I wouldn't even give that a vanishingly small probability. I'll go right to 0.
Yeah.
I'll go right to 0 as a probability on that. It is not convertible. The Chinese have adjusted the Shanghai Commodities Exchange where you can trade oil for gold directly, which means that you've taken the step of putting oil to dollars and dollars to gold out of it. But it's not the PBOC that's the gold that you're getting. It's the Shanghai Commodity Exchange. It's whatever gold they have there. And if you sell a lot of oil and want all their gold, if they don't have gold, then you can't get it. The PBOC is not going to back it up. The country is not going to back it up. The convertibility, the concept that the yuan would be gold backed. Hey, we have 8,000 metric tons of gold in Fort Knox, I believe. That's the number. The dollar's gold backed.
Right.
On that basis.
Yeah. Well, I mean, it sounds like the sort of the upshot of this is that sort of the disaster, you know, scenario that we worry about is not something that can happen overnight. I mean, it just can't happen in a short period of time.
I agree. I think that's exactly correct. I understand the concept. I know that countries, especially because the U.S. has weaponized its financial markets, it's weaponized the dollar, it's weaponized all of these things. And it's selecting winners and losers, which every country wants to do, and they're all annoyed that the U.S. can. Right? I mean, that's pretty much the way it is. So to me, I get the argument that why countries want to do it. The problem is there's sort of no alternative. Tina is the issue.
Well, and that's, I mean, you know, I can imagine that it is something that, you know, the sun can set on the dollar empire, but it's over 25 years.
I would say it's longer than that.
Yeah.
I would say it's longer than that.
Especially if we keep running massive deficits.
Right.
And giving more dollars to people.
I think that it would be inside 50 years, it would be incredibly surprising if the dollar was, so where are we now is 2023 and 2075. It would be incredibly surprising to me if the dollar was not still the global reserve currency.
Well, I'll have you back in 2070 and we'll give a update on that. But I think, look, I mean, the bottom line for all of this is, especially things that happen slowly, is that the answer from our perspective is to get your own fiscal house in order, get your own policies, your domestic policies in order. And the international stuff will, you know, if you're going to be a leader 50 years from now, it's not because China today decided that they were going to let you be a leader. It's because you made the right decisions, you make the right industrial policy or monetary policy, and you don't, you know, gut out your entire economy. It's not because, you know, some, you know, evil overlord overseas decided that they're going to, you know, destroy their own economy by trying to destroy yours. But
right. No, I agree. I think that's very true. And I think we didn't discuss, and I'm certainly no expert on it, but I think demographics is also another really important feature.
Fair.
You have the Chinese nation, which has a shrinking population.
Yeah.
And I don't know, I saw the estimate that by, I'll say 2050, the 1.3 billion people they have now is going to be somewhere like 850 million. That's a really big difference.
Yeah.
What does that say for what their economy is going to be able to do going forward? and then what tools they may or may not have to be able to affect whatever policies they want.
Well, look, we're running out of time. Actually, we've probably long since run out of time, but whatever. I mean, it's kind of as long as people will listen, I guess is this. But anyway, I hope you can come back another time. And I do like addressing bear porn and explaining why it's never as bad as all the people were shrieking about. Well, almost never. But before we let you go, tell me, what you're working on these days. Anything you want to pitch? A charity that you're contributing to, whatever you want to do. Here's your time.
So you know what?
And then I got to ask you the answer to the trivia question. But
yeah, I thought about that. I do not know the answer to that question. So my blog FX Poetry has been kind of stagnant for a while. I expect to start it up again. Actually next week is what I'm planning to.
And that's fxpoet.com.
fxpoetry.com.
fxpoetry.com. Yeah.
So
I subscribe, so I don't actually go to the website very often. fxpoetry.com. Yep.
I'm on Twitter, so I'm the FX at FX_poet. Remarkably, somebody was FX poet before I got there 10 years ago. I was a little confused by that. So I had to put the underscore in there. It all works out fine. So I'm looking at that, and I'm, after my 40 odd years in the market, I'm evaluating what it is I want to do going forward. Like I said, I do enjoy the writing, and helping companies. I'm looking at ways to put myself in a position to be able to work with companies as they think about their risks.
Look, I can endorse you. I think that I can endorse both the FX Poetry part of it, but also I think that you obviously, and for the last hour, we've sort of shown that you've got an awful lot to offer in this area. So I'm good luck, I guess.
Thank you.
And you say you don't know the answer to the trivia question.
I do not.
Okay, so
1931. It's like GE or something.
That's not terribly far off, but so because it is a consumer-oriented company, so and it's an iconic American company. Allstate was founded in 1931 as part of Sears Roebuck,
which is long gone, but Allstate's still there. And
that is interesting. So I learned that fact as part from a recent podcast Ted Seides did with Annie Duke, talking about Annie Duke's new book, and she pointed out, and it's about quitting. And the interesting part was Sears sold off a number of really successful businesses and then collapsed by keeping the part that they should have gotten out of a long time ago. Anyway, very interesting. So, Andy, thanks again for coming on here. That's all for today's podcast. Please like, subscribe, refer others, write a review if you are so moved. You can contact me at inflationguy@enduringinvestments.com. Subscribe for free to the blog at inflationguy.blog. If you want to subscribe to our quarterly or to my private Twitter account, go to inflationguy.blog/shop and use the code podcast at checkout to get $20 off a subscription. And most importantly, defend your money. And if inflation is coming for you, remember, you know a guy.